In 2025, you'll be able to put more money into a Roth account than ever before. Between a Roth IRA and an employer-sponsored account like a 401k, that number is $89,250. That new limit is thanks in part to a new IRS provision that applies to employer-sponsored accounts that goes into effect this year. In this video, we're going to break that number down into 3 separate buckets and explain how you can maximize everyone's favorite retirement account. Hey everyone, if we haven't met yet, my name is Jake Skellhorn. I'm a certified financial planner and the co-founder of Spark Wealth Advisors. This channel and my firm are both dedicated to giving you more confidence and clarity with your money. So the first bucket that makes up this huge contribution limit that you can add to a Roth account in 2025 is your Roth IRA. If you're under age 50, you can contribute up to $7,000 per year to a Roth IRA. And if you're over age 50, you get an extra $1,000 for a total of $8,000 that you can contribute to this account. It's important to note that Roth IRAs do have income restrictions that dictate who can contribute to them. This is known as a phase out. For 2025, if you're a single filer, the phase out is between $150,000 and $160,000. And if you're married filing jointly, the phase out is between $236,000 and $246,000. And what the phase out means is if you earn below that lower threshold of the phase out, you can make a direct contribution to a Roth IRA. If you earn somewhere in the middle, you can only do a partial contribution. And if you earn over the top limit of the phase out, you can't contribute directly to a Roth IRA at all. So if your modified adjusted gross income falls in this phase out or is above the phase out for this year, you can't make a direct contribution to a Roth IRA, but you may be able to do what's called a backdoor Roth contribution. And what that entails is basically making a non-deductible contribution to a traditional IRA first, since there's no income limitations to do that, and then simply converting it to a Roth IRA. I made a separate video where I go into more detail on this strategy, but there's essentially 2 things you need to look out for if you're doing this. Number 1 is called the pro rata rule, which could lead to your conversion being taxable if you have any pre-tax dollars already in an IRA. And number 2 is that you have to file a tax form each year called Form 8606. Once again, I'll link that video in the comments below for more details. And the second bucket here is simply your salary deferral limit for contributing to an employer-sponsored plan, such as a 401k, 403b, or 457 plan. For 2025, the ordinary deferral limit is $23,500. That's if you're under age 50. If you're over age 50, you can do a catch-up contribution, which is an additional $7,500, bringing that total to $31,000 that you can contribute. And the new provision that I alluded to at the beginning of this video is what's called a super catch-up. Now, if you're between the ages of 60 and 63, instead of $7,500, you're now able to contribute $11,250 as your catch-up contribution to your Roth 401k. My understanding of this new rule is that it is based off of your age at the end of the calendar year, meaning if you're turning 64 at some point during this year, you would only be able to do the ordinary catch-up of $7,500 and not the $11,250. A couple important notes regarding this bucket. Number 1 being just because you can contribute that much to a Roth 401k doesn't mean you necessarily should. For example, I work with a lot of clients who are higher income, and it makes more sense to contribute to the pre-tax account for this bucket compared to Roth. So it may have a better tax benefit to deduct that money in a high tax bracket today and withdraw at a lower tax bracket later, or do Roth conversions down the line. So just because you can doesn't mean you should. The other thing is to look out for what's called a true-up contribution. If you're someone who likes to max out their 401k very early on in the year because you have, say, a bonus or something like that, you want to make sure that your company offers a true-up match, meaning that they will still honor what their match would have been throughout the full year if you evenly contributed to your 401k throughout the year instead of maxing it out all at once. So check your summary plan description to make sure they offer a true-up match. If they don't, you generally want to spread out your contributions so that you take full advantage of the company match. One other important thing to know is that starting in 2026, your catch-up contributions are required to be Roth if you're considered a highly compensated employee. So if you earned over $145,000 the year before, your catch-up contribution specifically has to be Roth now, whereas before, including this year in 2025, you're allowed to pick pre-tax or Roth. So keep that in mind next year. So just to recap on bucket 2, you can contribute $23,500 to your Roth 401k if you're under 50. If you're over 50, that's $31,000. And if you're between the ages of 60 and 63 specifically, that is $34,750 that you can contribute directly to your Roth 401k. And bucket number 3, which makes up the vast majority of this massive limit for this year, is referring to what's called a mega backdoor Roth, and that is contributing after-tax dollars to your employer-sponsored plans such as your 401ks and 403bs, and then immediately converting that money to your Roth 401k or converting it out to a Roth IRA. For those that are unfamiliar, defined contribution plans like 401ks have what's called a combined limit. It's also called a 415C limit, and that is the combined contribution limit that you and your employer can make to this plan on a given year. For 2025, that amount is $70,000 if you're under 50. If you're over 50, $77,500. And if you're between 60 and 63, it's $81,250. So to calculate the amount that you can potentially contribute on an after-tax basis that you can then convert to Roth is by taking this combined limit, subtracting your salary deferral limit, which is that bucket number 2, and subtracting any employer contributions. Obviously, this part will vary from employer to employer, so you will want to calculate what your expected company matches throughout the year to arrive at this figure. So that means if your employer does not match anything or put anything into your 401k, you can potentially contribute up to $46,500 in this after-tax bucket. I will say that this will be pretty rare that you'll be able to contribute this full amount, because employers generally will do some sort of safe harbor matching contribution to avoid discrimination rules in 401k plans. That means they're required to make it even for highly compensated and low compensated employees of the company, but that is nonetheless the maximum you'd be able to contribute. If you have a solo 401k, obviously you don't have any employees, you're self-employed, you and a spouse would likely be able to contribute the full amount to this after-tax bucket. A couple important points on this bucket is that not all employers do allow for after-tax contributions, so this is obviously a requirement to take full advantage of this bucket. So check your summary plan description to see if after-tax contributions are allowed. The other thing that has to be allowed is what's called an in-plan Roth conversion or an in-service rollover, which is where you would convert it to a Roth IRA outside the plan. And the reason that you need that second provision for this strategy to be successful as well is because if you do an after-tax contribution and you just leave it, it gets invested and it grows, any of the earnings on those contributions will be considered taxable when you withdraw them. So by converting those after-tax contributions to Roth immediately, all of that growth is going to be tax-free. So let's recap on all three of these buckets one more time based on your age. If you're under age 50, you can do that $7,000 to a Roth IRA. You can do $23,500 to a Roth 401k, and then you can do up to $46,500 to a mega backdoor Roth IRA via those after-tax contributions for a total of $77,000 in 2025. If you're over age 50, those numbers are $8,000 to your Roth IRA, $31,000 to your Roth 401k, and again, up to $46,500 to your mega backdoor Roth. Lastly, if you're between 60 and 63 in 2025, you can contribute $8,000 to your Roth IRA, $34,750 to your Roth 401k, and up to $46,500 to your mega backdoor Roth for a total of $89,250 that you can potentially get into a Roth account this year. So I hope this video was helpful for all my super savers out there that want to get as much money into a Roth account as possible this year. Like I mentioned, for bucket number 1, there are some mistakes that can be made if you don't do a backdoor Roth correctly. If you want to watch that video I mentioned earlier, you can check it out now. Besides that, subscribe to the channel for any future videos like this one, and we will see you there. Thanks for joining.